Hello, my name is Tom Clark, Director of Investments at Signature FD, filling in for our CIO, Tony Welch, on this week's Cutting Through the Noise. Today, I'm going to touch on the election, but really talk about three additional topics: the market's reaction to the election and the current market fundamentals, macro headlines led by the Fed's rate decision, and then lastly, we'll talk about some updates on some market trends. So in the wake of the election, what we've seen is many analysts have been predicting the winners and losers from an investment perspective under the next Trump administration. Often what we see from these analysts is they take campaign promises and extend them to several years of returns based on various types of investments. However, while we are researching the possible outcomes through some very thoughtful experts, such as those inside of our research providers, the reality is the future is unpredictable. If you take tariffs, for example, a common narrative suggests that a global tariff rate could be inflationary. However, we would point out it's uncertain if the president-elect has the authority to impose these tariffs, and even if he does, whether they would be implemented or sustained and for how long, and to which countries they would apply to. Moreover, the economic landscape will determine if companies can actually pass these tariffs on to consumers. Historically, tariffs have actually had more of a demand hit than a supply shock. So as we turn our discussion today to the markets in the wake of the election, stocks clearly rose. And so what we saw was large company stocks, which is referenced by the S&P, were up almost 5% at 4.7%. Small companies did even better, almost going up 9% at 8.6%. In terms of how companies are performing fundamentally, what's interesting to us is most companies have released earnings, and what we've seen is both sales and earnings for the third quarter are up over 5%. So what we see is that fundamentals are strong among U.S. companies, and the final point we would make is that operating margins are 8% above long-term averages. So now that we've talked about the markets, let's transition to the economic update. And what we saw last week was, for the first time in a while, the Fed meeting probably flew under the radar for a lot of our listeners, despite the fact that it did cut rates again for the second time since September. So this time they cut by a quarter point. The last time it was a half a point. And so where we are is, since September, they have now cut 0.75 percentage point. And the attention for the next Fed action will be in December when they have their next meeting. And for that meeting, the Fed's current guidance is they are in an easing cycle, meaning that future cuts are likely. They're not guaranteeing December, but that's the path of where the rate activity is heading. So the Fed no longer sees the labor market as a source of inflationary pressure, and we agree with this statement. Beyond the Fed, the data last week had some upside surprises, and positive trends have really been the norm lately. So for example, we saw the Consumer Confidence Index exhibit a very strong monthly increase. In fact, the biggest we've seen since March of 2021, with all 5 of the components of this index going up. We do have a bigger week in the data front this week, where we have small business confidence coming out. That will be through October, so we're not going to have a view into the small business view of the election. And then we're going to see several different inflation data points, which will probably feed into the Fed's decision, which again is in mid-December. So the final indicator, which we'll touch on today, that also appears in our written weekly investment update, is the market trend. So with the US stock market showing strength for the past couple of years, there's naturally some skepticism about, can returns remain positive ahead of the market's third birthday, which it would have had 3 years in a row, and that's coming up this fall. Interestingly, historical data shows that most bull markets reaching the age of 2 often continue to their third birthday unless they're derailed by a recession. Currently, the economic momentum appears strong enough to keep recession risks at bay, which would support a continuation of this bull market. Now that we have shared our market update and the trends and discussed our current macroeconomic picture, we thank you for joining us this week, and we look forward to sharing our thoughts with you again next week on Cutting Through the Noise. Thank you very much.